Most men lose their money in the market not because they can't pick the right stock, but because they never learned how much to buy of it. That's the real secret. Not just what to trade, but how much of it to hold. Now, if you remember the previous video on how to catch early signals of trend, I told you that spotting the turn is one thing, but holding your position when the tide moves is another. Well, today we're talking about the glue that holds that entire idea together, the Fei-1 rule for position sizing. You see, when I first started, I thought trading was about being right. I wanted to hit the bull's eye every time, double my stake, and walk out grinning. But the market has a way of teaching you that being right isn't the game. Surviving is. Tell me, what good is catching a perfect move if one bad position wipes you out the next day? That's not trading, that's gambling. Position sizing, my friend, is how you stay in the game when everyone else is losing their seat at the table. It's the invisible hand on your shoulder that says, "Easy there." Don't let excitement talk you into a bigger bet than your account can carry. Most traders don't listen to that voice. They get one winner, feel 10 feet tall, and double up on the next trade. And when that next one goes against them, because it always does, they're back to zero. I learned long ago that the market doesn't pay the boldest man. It pays the one who plans his risk like a general planning a war. You don't send your whole army into every battle. You scale your attack depending on the terrain. You advance when the odds line up, and you retreat when they don't. Doesn't that make sense to you? Now, let's get something straight. Position sizing isn't about being timid. It's about being prepared. You size your position so that a single loss won't cripple you, but a winning streak can still grow your capital. That's how wealth is built in trading, not by wild swings, but by steady compounding. A trader's fortune is just his discipline written in numbers. When I look at a chart, I don't just see price, I see risk. Every bar, every candle, every little tick is whispering a story about how much pain the market can hand you before it turns. You must read that story. You measure your risk, not in emotion, but in distance. The distance between your entry and your stop. That's your line of defense. You size your trade based on that line, not on your hunch, not on your hope. Ever notice how the amateurs always talk about profits, and the professionals always talk about losses? That's no accident. The pro is thinking about survival first, profit second. If you size your position right, the losses don't hurt you. They're just the cost of doing business. But if you size it wrong, if you go too heavy, too fast, even one ordinary loss becomes fatal. And here's something I'll tell you plain: the best position sizing is the one that lets you sleep at night. If you're staring at your screen, sweating over every tick, you've bet too much. Trading isn't meant to keep you awake. It's meant to keep you free. You should be able to walk away from any trade and not worry if it hits your stop while you're gone. Because if that one trade can break you, your position was never sound. Now, let's tie this back to what we talked about before. Catching those early signals of trend. You remember I said that the early signal is your edge, but it's only valuable if you can stay with it long enough to let the move unfold. Well, position sizing is what allows you to do that. If you've bet too much, you'll get scared out of your position the first time the market breathes against you. But if you've bet right, you can hold through the noise and let your winner mature. That's the difference between catching a swing and riding a trend. You see, every trader has two enemies, fear and greed. Position sizing is how you chain both of them. Too small, and fear keeps you from meaningful gains. Too large, and greed pulls you into ruin. The balance point, that's where mastery lies. It's not a formula written on paper. It's a feeling you develop from experience, from watching the market turn and twist under your hand. When I'm trading, I never think of how much I can make. I think of how much I'm willing to lose if I'm wrong. That's my foundation. Once you fix that number, your risk per trade, the rest becomes mechanical. The market can do whatever it pleases, and you'll still be standing when the dust settles. And tell me, what's the good of making a fortune if you lose your nerve along the way? Traders talk about courage, but the real courage is not in doubling down. It's in cutting your loss, admitting you're wrong, and keeping your powder dry for the next move. Position sizing is the habit that makes that courage possible. It gives you the confidence to take the next trade, and the next one after that, without hesitation. You know you're safe because you've built safety into the numbers. A man once asked me how much of his account he should risk on a trade. I told him, just enough so that if it goes wrong, it stings but doesn't scar. Because scars in trading aren't just on the balance sheet. They're in your mind. Blow up once, and it takes months to trade without fear again. So why let it happen at all? Think of position sizing as your seatbelt. You don't wear it because you expect a crash. You wear it because you know one can come at any time. You don't control the market, but you control your exposure to it. That's your real edge. Charts give you clues, price gives you timing, but position sizing gives you longevity. And longevity, my friend, is what makes a trader rich. Sometimes I wonder, why do traders spend all their time chasing better entries, better indicators, better systems, and yet ignore the one principle that actually decides who survives? Maybe it's because it's not exciting. Nobody brags about risking less, but the quiet discipline of small, controlled risk. That's what keeps the lights on when the market goes dark. You can make mistakes with your analysis and still live another day, but make one mistake with your sizing and you're finished. So when you sit down to trade tomorrow, don't ask yourself, what should I buy? Ask instead, how much should I buy? Because that's the question that separates the old hands from the newcomers, the professionals from the dreamers, the rich from the ruined. Survival in trading matters more than being right. That's the lesson every real trader learns sooner or later, though most learn it the hard way. The market doesn't reward correctness, it rewards endurance. You can make 10 trades, be wrong on 6, and still walk away a winner if your losses were small and your winners were allowed to grow. But if you risk too much on one idea just because you believe you're right, then one bad turn can end your career. Tell me honestly, what good is being right if you can't stay solvent long enough to prove it? When I started in the bucket shops, I thought being right was everything. I would study the tape, catch the direction, and jump in with both feet. It worked, until it didn't. The market doesn't move in straight lines. It breathes, hesitates, and shakes you out before it goes your way. I'd be right about the trend, but I'd size my position so large that one little shakeout would throw me off the train. And there I was, watching the move I'd predicted unfold without me. That's when I began to understand that survival, staying in the game, is more important than the satisfaction of being right. The trouble with being right is that it's a matter of ego. You start defending your opinions instead of protecting your capital. The market doesn't care what you think. It only cares about your exposure. When you're wrong, it takes your money without hesitation. When you're right, it rewards you. But only if you're still standing. And most traders don't last long enough to collect their winnings because they bet too heavy when they thought they were sure. Have you ever noticed how certainty makes you careless? That's when you stop managing risk, when you tell yourself, this one can't lose. But that's exactly when the market proves you wrong. I've seen traders blow up not because they were bad analysts, but because they didn't respect the one rule that matters: preserve your capital. A man who loses half his stake has to double it just to get back to even. That's not a trading plan, that's a rescue mission. Every dollar you lose is a soldier gone from your army. If you lose too many, you can't fight another battle, even when the perfect opportunity appears. So what's the use of being right about the market's direction if you have no money left to take advantage of it? The old timers used to say, a trader who can't take a loss will never make a fortune. I found that to be true every single time. The ability to survive the losing streaks, to absorb the hits and still have ammunition. That's what separates the professional from the amateur. You can be wrong half the time and still make a fortune if you keep your losses small. but you can be right 9 times out of 10 and still go broke if your 10th loss wipes you out. The numbers don't lie. It's not about accuracy, it's about endurance. You might think survival sounds like a dull goal. Everybody wants to win, to grow their account, to hit the big play. But think about this. Growth is impossible without survival. The longer you stay in the game, the more chances you get to capitalize on your edge. Every trade is just one round in a long fight. If you protect yourself in the early rounds, you're still there when the real opportunities come. Isn't that better than being a one-hit wonder who burns bright and disappears? The problem is that traders get addicted to being right. They start measuring their skill by how often they win instead of how well they manage risk. But the market doesn't care about your win rate, it cares about your payoff ratio. You can lose more often than you win and still make a living, if your position sizing keeps you alive. The men who last decades in this business don't measure their worth by victories. They measure it by how many battles they survived. You must treat trading like a business, not a crusade for correctness. Businesses have expenses. Losses are yours. You manage them. You budget for them. You control them. When you stop fearing them, you start trading like a professional. I learned that being wrong is simply part of the process. It doesn't make you a bad trader, it makes you a realistic one. What destroys traders is not being wrong. It's refusing to admit it. The ego can't stand to lose, so it keeps doubling down, chasing, adding to losers. And then one day the account's gone. You can't trade for a lifetime if you treat every position like a personal statement. The market doesn't test your intelligence, it tests your humility. Can you accept when you're wrong and move on? Can you preserve your capital for the next setup? Because that's all trading really is, waiting for the next good setup and having the capital to take it when it comes. When you stop caring about being right, you start seeing the market clearly. You stop arguing with it and start listening. The tape tells you what's happening. Your job is to respond, not predict. You manage your positions, you control your risk, and you live to trade another day. That's the mindset of a survivor. The man who lasts the longest isn't the smartest or the boldest. He's the one who refused to go broke while learning. Every trade carries uncertainty. You can't eliminate it, so you must plan for it. That means never risking enough to destroy yourself if you're wrong. It means always knowing, before you enter, exactly how much you can afford to lose. If that loss would put you out of business, the trade's too big. You see, survival is not cowardice. It's strategy. It's the discipline that allows you to stay calm when others panic, to act rationally when others are ruled by emotion. A trader who survives long enough eventually becomes right often enough. But the one who risks it all for the sake of being right just once never gets the chance to see that day. Survival is the silent victory that no one celebrates, but every professional respects. It's the foundation upon which every winning trade, every great campaign, every fortune in the market is built. Risk must always be measured before profit is imagined. That's the cornerstone of real trading, and it's the rule that separates professionals from dreamers. Every man who has ever gone broke in the market did so because he chased the reward before counting the cost. The beginner sees profit, the professional sees risk. The difference between the two isn't intelligence, it's perspective. One is hunting excitement, the other is protecting his future. Tell me, when you put on a trade, do you first ask how much you might make, or how much you could lose if you're wrong? That question alone reveals the kind of trader you are. When I was a young man trading in the bucket shops, I used to think that courage was about taking big chances. I believed fortune favored the bold. But as the years went on, I discovered that the market punishes boldness without calculation. I'd enter trades with confidence, thinking only of the profit I'd pocket when it moved my way. Sometimes it did. But when it didn't, the loss hit harder than I ever planned for, because truth be told, I hadn't planned for it at all. That's how most traders fail. They imagine the gain, but they never measure the risk. The market isn't a field of opportunities, it's a minefield of probabilities. Every step you take has a cost, and every potential reward comes tied to risk. Before you imagine where the price might go, you must know exactly where you'll get out if you're wrong. That exit, that point of defense, defines your risk. Without it, you're walking blindfolded through moving traffic. A trader who doesn't define his risk in advance isn't trading, he's gambling with hope as his only strategy. And hope, in the market, is the most expensive feeling you can afford. You see, profit is what the market gives you. Risk is what you give the market. The trick is to make sure you're giving less than you're taking. That balance, that ratio, is what decides your future. You might win only 4 trades out of 10, but if your average win is twice as large as your average loss, you'll come out ahead. But if your losses are unmeasured, unlimited, then even a high win rate can't save you. Tell me which sounds wiser, to dream about gains you can't control or to manage losses that you can. I've always said that a trader's real job is not predicting direction, but controlling exposure. You can't predict the market, but you can control how much damage it does to you when you're wrong. That's the difference between survival and ruin. Before I ever enter a trade, I ask myself one thing: what's the worst that can happen? If I can accept that outcome without fear, then the trade is safe to take. If I can't, then I have no business being in it. That simple question has saved me more money than any chart, indicator, or forecast ever could. Most traders, especially beginners, fall into the trap of imagination. They see a setup forming, and their mind jumps ahead to profits. The yacht, the freedom, the feeling of being right. But that same imagination blinds them to risk. They don't see the price whipsawing against them, the margin call, the account drawdown. They picture the win, never the loss. And when the loss arrives, as it always does, it feels like betrayal. But it isn't betrayal, it's mathematics. The market doesn't owe you profit, it only offers probability. In trading, you measure risk the same way you measure temperature before stepping into the weather. It's your preparation. It tells you what to wear, how far to go, and when to stay inside. Without it, you're exposed to every storm the market throws your way. That's why I always said, speculation is as old as the hills, but the rules never change. You measure your risk first, and your profit will take care of itself. The traders who reverse that order never last. Now, how do you measure risk? You start with the chart, of course. Every chart tells you where the danger lies, the last swing low, the resistance overhead, the volatility of the recent bars. Your entry point and your stop define the battlefield. The distance between them is your risk per share. Multiply that by your position size, and you know your total exposure. That number should never be left to chance. It should fit within your risk tolerance. A small, controlled portion of your capital. If that loss would wound your account or your confidence, it's too large. When you trade this way, you stop reacting emotionally. You know your risk before you begin, so there are no surprises. A losing trade becomes just another data point, not a disaster. You cut it, record it, and move on. But when you trade without measuring risk, every move feels personal. Every tick against you feels like the market attacking you. That's when traders break their rules, move their stops, and turn a small, acceptable loss into a major wound. It's a curious thing. Traders love to talk about reward to risk ratios, but few actually live by them. They'll say, I'm risking 1 to make 3. But when the trade moves against them, they hold and hope. And when it moves in their favor, they take profits too early, afraid it might reverse. That's backward. If you measured your risk properly, you wouldn't need to grab profits prematurely. You'd let the market pay you fully for the risk you assumed. The beauty of measuring risk first is that it gives you control in a business built on uncertainty. The market decides direction and timing, but you decide exposure. You can't dictate profits. That's the market's job. But you can dictate how much you'll lose if you're wrong. That's your job, and that's the only power that truly matters in speculation. When you think in terms of risk first, something changes in your mind. You stop seeing the market as a source of riches and start seeing it as a test of discipline. You stop chasing opportunities and start waiting for favorable odds. You stop needing to be right and start needing to be consistent. That's how a trader evolves from a gambler into a strategist. If you walk into the market without measuring risk, you're stepping into a storm without an umbrella. But if you walk in prepared, knowing exactly what you can afford to lose, then every trade becomes just another calculated move in a long campaign. You might lose some, you might win some, but you'll stay alive long enough to see the tide turn in your favor. Because in trading, risk is the only thing you can measure, and profit is only what's left when risk is properly controlled. A trader's longevity depends on consistent risk control per trade. That's the truth most people don't want to hear, because it sounds dull compared to dreams of massive wins and overnight fortune. But the market isn't a sprint. It's a lifetime marathon where survival means more than victory in any single round. The traders who last are not those who catch every move or predict every turn. They're the ones who protect their capital every time they take a position. Tell me, what use is a brilliant analysis if one oversized trade wipes out all your past profits? Longevity in this business isn't luck, it's mathematics mixed with self-control. When I first started, I thought success came from being clever, reading the tape faster than the next man, spotting turns before the crowd. But after watching many smart men go broke, I realized cleverness isn't what keeps you alive in this game. It's consistency. Consistent risk control, applied trade after trade, even when you're feeling confident, even when you're sure of the outcome. That's what separates the professionals from the hopefuls. The amateurs make their bet size emotional. The professionals make it mechanical. You see, every trade is uncertain, no matter how strong it looks. The market doesn't owe you clarity. That's why consistent risk control is your safety net. It's the rule that says, no single trade should ever threaten my ability to trade tomorrow. Most traders break that rule when they feel invincible. They have a few winners, the confidence swells, and suddenly they're risking triple the usual amount. Then the market snaps back, and one loss erases months of work. Have you ever been there? Watching a single mistake undo weeks of discipline. It's a sick feeling, but it's also the best teacher if you learn the right lesson. Protect yourself on every trade without exception. The market is full of surprises. It doesn't matter how well you read the charts or how deep your conviction runs. There will always be trades that turn against you. That's why risk control can't be something you use occasionally. It must be a rule as constant as gravity. Each trade, no matter how small or promising, must fit inside the same risk framework. Professionals know exactly how much they're willing to lose on any given position. Maybe 1%, maybe less, and they never exceed it. That way, no single trade has the power to ruin them. Consistent risk control is like insurance. You don't buy insurance because you expect disaster every day. You buy it because you know disaster is possible any day. And when it comes, you want to survive it without devastation. That's how a trader lasts through the years. Not by avoiding losses, but by ensuring losses stay manageable. Think of it like this: your capital is your inventory. When you lose too much of it in one trade, you reduce your ability to take future opportunities. And opportunities are what generate profits. So, if you drain your inventory, you drain your future. There's another part to this. Consistency isn't just financial, it's psychological. When you risk a steady, small percentage every time, your mind stays calm. Your emotions don't swing wildly between greed and panic. You can evaluate your trades objectively because you know none of them will destroy you. But if your bet sizes are all over the place, small on some trades, huge on others, your emotions will follow the same pattern. You'll be confident one day and terrified the next. And emotion is the death of good judgment in trading. Every experienced trader learns that consistent risk control gives freedom. It sounds paradoxical, but it's true. When you limit your downside, you gain the confidence to take the right trades without hesitation. You can hold winners longer because you know your foundation is solid. You can think clearly because your future doesn't depend on one outcome. Doesn't that sound like the kind of freedom every trader wants? I remember many traders who started strong. Bright, bold, full of theories. and for a while, they seemed unstoppable. They'd make huge gains, brag about catching every move, but then one bad streak would hit, and they'd lose everything. They didn't fall because they didn't know how to trade. They fell because they didn't know how to control risk consistently. Their confidence rose and fell with their account balance. They played offense but never learned defense. In the long run, defense is what wins. Consistent risk control also builds something that can't be measured in numbers. Trust in yourself. When you know that your rules protect you, you no longer second guess every decision. You stop hesitating on entries because you know exactly what you stand to lose. That confidence allows you to execute without fear. The key is not to make every trade profitable. It's to make every trade safe enough that you can keep trading indefinitely. Think of trading like navigating an ocean. The waves are unpredictable, sometimes calm, sometimes violent. You can't control the sea, but you can control your ship. Risk control is your ballast, the weight that keeps you steady when the storms come. Without it, even a skilled captain gets tossed overboard. Consistency in your risk keeps your ship afloat through every kind of weather. It's easy to follow your plan after a loss. Fear keeps you cautious. The real test comes after success. Success tempts you to forget the rules, to believe the next trade is a sure thing. That's when discipline counts the most. If you can apply the same measured risk after a winning streak as after a losing one, then you've reached maturity as a trader. That's when longevity begins. Because markets will change, trends will reverse, systems will fail, but disciplined risk control endures through all of it. You must remember, the goal isn't to avoid risk. That's impossible in trading. The goal is to make risk predictable and manageable. It's to risk the same fraction every time, regardless of how confident or uncertain you feel. It's to make sure your account can survive a string of losing trades without shaking your confidence or your capital. That consistency is your edge. While others burn out chasing fast profits, you'll still be there, trading calmly, watching their names fade as yours endures. If your risk per trade is stable, your results will stabilize too. You'll stop living and dying with every position. You'll start thinking in terms of long campaigns instead of single battles. And that's how traders last for decades, not through luck or brilliance, but through discipline so consistent it becomes instinct. Because in the end, a trader's true wealth isn't in a single winning trade, but in the ability to keep trading tomorrow, and the day after that, and for as long as the market opens its doors. The question, how much should I buy, matters more than, what should I buy? Every young trader starts with the wrong question. They ask, what stock should I pick? Which setup looks best? What's going to move next? They chase the idea that success in the market comes from picking the right horse. But the truth, the kind you only learn through scars, is that what you buy doesn't matter nearly as much as how much of it you buy. The market doesn't destroy traders because they choose bad stocks. It destroys them because they take positions too large for their capital. Tell me, how many times have you been right about a trade and still lost money because your sizing was wrong? When I was young and reckless, I thought my edge came from being clever, spotting trends before the crowd, jumping in early, holding through noise. And yes, those things matter. But as I traded longer, I saw men far smarter than me blow up accounts simply because they never learned this one principle: control your size, or the market will do it for you. You can survive bad entries, slow markets, and even long losing streaks, but you can't survive betting too much. The market will always find your weakness, and oversized positions are the biggest weakness of all. The question, how much should I buy, is really a question about survival. It's asking, how much can I afford to risk and still live to trade another day? The amateurs ask about potential. The professionals ask about endurance. A trader who sizes properly can take 100 trades and still be calm. He knows no single one can sink him. But the gambler, he bets heavy on conviction, and conviction is just another word for ego. When that trade turns, he learns the market has no mercy for those who confuse confidence with control. There's a funny thing about being right in the market. It feels good, too good. One big winner fills your head with the illusion that you've figured it out. So what do? You double your next position. You think, I'll make twice as much this time. And that's exactly when the market teaches its lesson. The next trade doesn't just take your profit, it takes your composure. You find yourself staring at the screen, frozen, watching the numbers turn red, because you forgot the one rule that keeps a trader alive: never let one position mean too much. A trader's position size should never be determined by emotion. It should be a cold, calculated number based on risk tolerance, not excitement. The chart can look perfect. The setup can scream opportunity, but if the risk is too great for your account, you take a smaller bite. You don't need to swing for the fences to make money in trading. You just need to stay in the game long enough for your edge to play out. And your edge can only play out if you survive the losses along the way. That's why the question of how much is more powerful than what. The truth is, there's no perfect trade. Every position carries uncertainty. Even the strongest setups fail, even the cleanest trends reverse, and even the best traders get caught off guard. So you can't measure success by the trade outcome.